Hey friends, welcome to another episode of Navigating the Markets with me, Markets and Mayhem, coming to you Sunday, February 11th, 2024. Let's take a quick look at the year-to-date performance in the S&P 500. Obviously, NVIDIA is leading the way, up 45.66%, followed by Meta, up 32.25%, Palo Alto up 27.82%. Cybersecurity remains a strong theme here. And Eli Lilly up just shy of 27%. But as we look closely at this chart, we see that it's not all green, it's not all gains. The rally year to date has been pretty concentrated. It has not really been evenly distributed. There's been whole sectors in the market that have been left out, like real estate, utilities, basic materials, or at least chunks of it, and energy. Just not exactly a powerful continuation of a bull market. And the reason that I bring this up is because when bull markets make all-time highs, you really do want to see wider participation, and we're not. And it's a bit concerning. It doesn't mean it's the end of the rally. It just means it's a cautionary note. And for me, the way I'm looking at this is, if we do see that turn, there's one of two ways it can potentially turn. Like I was talking about on the midweek update, if we see an expansion of breadth, something I've been talking about as a concern, but also as an area to watch for if there's improvement for many, many months now. That could change the paradigm. That could improve things. We could see a broadening out of the rally. For that to happen, we need to see equal weight and small caps start to outperform. Again, this is a phenomenon I've been mentioning, I think, for at least 4 or 5 months. That's what we want to kind of watch to see whether or not this really continues to be a rally that can deliver. And if it ends up that doesn't become the case, that it doesn't broaden out, then it really is a rally in a handful of stocks that are leading the indices higher. And that means that any materially adverse event for any of those stocks could be a huge problem for this market. We do have NVIDIA earnings coming up, and I believe on the 21st. That's going to be really important. They could very well beat, and they could continue to surge. But if they don't, that's one of those materially adverse events, because a lot of this rally has been predicated on AI. The two leading stocks this year, NVIDIA and Meta, a lot of that was about AI as well. So, I look at NVIDIA and Microsoft and some of these other companies as the sellers of picks and shovels during the gold rush. During the gold rush, very few people that were mining for gold made a lot of money. But the people that were selling the tools to mine for gold, they killed it. And that's what NVIDIA and Microsoft are doing. They're sort of at the top of that tower. Supermicro is kind of in that configuration as well. But we have yet to see the bottom line improvements and productivity improvements across a wide variety of sectors. And I think that's a bit of an issue. Another pick and axe seller, or pick and shovel seller, you could say, is probably Palantir as well, which is now being recognized by the market more and more. A stock I've been involved with since its IPO, and one that I remain constructive on for the long term, although I wouldn't necessarily be adding to positions at the current lofty levels. I think 25 is a hard ceiling given options positioning unless we start to see people meaningfully roll their calls up. So, long story short, would really like to see a lot more green in this map. That would make me feel a lot better about the market having sustainability to keep pushing towards new all-time highs. If we don't, then that concentration risk becomes a bigger concern. And we've seen market environments where there's this kind of concentration and it doesn't end too well. So I'd rather personally see a broadening out, but I'm not so sure that's what we're going to see since we haven't yet. And that's one of my concerns. But we do have some encouraging signs underneath the surface. So, that broadening out, maybe it's in its early stages, at least in the NASDAQ. We saw 228 new highs in excess of new lows last week in the composite. That is a good sign. That is actually the highest number of new highs versus new lows that we've had since 2021. Think about that. That's a pretty big event, I would say, that you see the new highs in excess of new lows, the most that we've seen in years. right? About 2.5 years. So that could indicate that we're starting to see some of those promising signs begin as of last week. We need to see this continue. It needs to broaden out. It needs to become a more consistent theme. If that happens, then a lot of the mid cap and small cap techs could start to outperform the larger cap, and maybe that's how the rally broadens. We've yet to see that as a sustaining theme. 1 week does not make a trend, so let's keep an eye. Next, we see the number of NASDAQ stocks above their 20-day moving average broadening out, again, part of that theme, to 52.13%. That's also a good sign. Now, during this rally, we've really seen it really kind of peak out in the 70s to 80s as to when the rally starts to kind of unwind a lot of the time. That's sort of the extreme that we've seen in the number of stocks above that 20-day moving average. So I'm showing this chart to say we could still have room to push higher in this impulse move, especially if the rally continues to broaden out. But we should begin to show some caution above 60, particularly as we get to the 70s and 80s. Should we get there? Now, the CBOE put to call ratio for stocks and ETF options reached a euphoric extreme on Lotto Friday last week, 0.48, which means there was an excess of 2 calls transacting for every 1 put. And that is because most of those calls are being bought to open, is often a pretty bullish sign in terms of what sentiment says, but it can be a bit of a contrarian indicator. So I would look at this and just say people are feeling really, really good right now. So that does question how much dry powder, so to speak, is left on the sidelines that actually wants to go into equities. We know there's $6 trillion in money markets, but does that money want to go into equities, or is it looking more for fixed income, since most of that money is from savers and corporates and otherwise? Now here is the S&P large cap low vol versus high beta. This is showing us extreme greed. There is so much appetite for high beta versus low vol here that we are almost at the levels that we saw in late December 2023 before we saw that brief market drawdown. So this is another indicator that's a bit stretched. It just suggests to me that we need some kind of correction, whether it's in time or price or both, because things are getting a bit stretched. And I would hope that folks start to look at some of these beaten down, more defensive parts of the market as being potentially attractive, because there are some values there. Now, this is a new all-time high in the ratio between the New York FANG Index and the S&P equal weight. We've never seen it at 1.536 or anywhere close to that. This is a melt up, and this goes to show that high level of concentration in just a handful of stocks. And retail remains quite bullish of U.S. equities. We can see that they're 49% bullish, 22.6% bearish, 28.4% undecided. This is pretty darn adamantly bullish. We've pulled really ahead of those low readings we saw just 2 weeks ago, where it was just 39.3% bullish and much more undecided at 34.6%. This is a survey of people looking out as to where the stock market will be in the next 6 months. So it's forward looking, and we can tell that people are getting really bulled up again, which again, it does start to beg the question, how much money is left to keep buying here, at least from this segment of retail, right? It does. And again, this is not a sign of like imminent top as much as getting stretched in sentiment, which can lead to stretched flows and stretched positioning, which ultimately, when you get a reversal, can lead to more, I would say, determined selling, because you have more folks that were piling in at higher levels. So if the market does turn around and we do see some downside, you have folks that have been piling in at these highs that could become more motivated to sell. Similarly, we see that with managed money. Apologies for the blurry chart. This is from the NAAIM website. That number climbing again last week. I think it's over 92 now. This is the highest that we've seen since late last year. Once again, suggesting this is a market that is very, very optimistic. This is a survey of managed money positioning, and they're very net long. We also have skew coming down into OPEX week, which it's still elevated. Skew is still relatively high. I wouldn't necessarily call this a well-hedged market. I'd call it a reasonably hedged market. This should add to the passive flows we see from delta and theta decay as we get into OPEX week. And those flows tend to pause for a while post expiration. So we're looking at this saying we'll probably get a decent bid Monday through Wednesday. But, Thursday, Friday could be a bit more choppy next week. And the second half of February does seasonally tend to be a more difficult time of the month. So Thursday, Friday, and on in February is a seasonally difficult time, especially for tech stocks. And I think that could end up being the case. We'll talk a little bit more about why that is. Now, single stock call skew is very bullish going into OPEX. Shown below is Microsoft. This is not in isolation. Many of the most popular optionable stocks are showing similarly stretched bullish sentiment as we get into OPEX week. Now, this has the opposite effect on these stocks. That is to say, if there isn't a continuation of these buying flows, you have these delta and theta decay flows that cause liquidity come out of these stocks because dealers are able to sell shares, which were their hedges when they were selling call contracts to speculators. So this is interesting going into next week. If we don't see a continuation of those bullish flows, these stocks could be a little bit more wobbly. Similarly, we see Nvidia showing really, really blown out call skew, the highest we've seen since the summer of last year. Google, also the highest call skew, blowing out to extreme bullishness. This is another bit of a concerning sign that there's just so much optimism in these stocks. And we saw it in the equity put call ratio and volume, but we're seeing it in skew. That's confirmation that there is a lot of bullishness in these stocks, which again starts to beg the question, does this start to work against more upside? Is this going to be a limiting factor? And then Meta, wow, this is the most extreme call skew that I've ever seen in this stock. And this is where I would be most concerned about how much more upside there is in the Meta story here, because without a powerful continuation of these supportive flows, this stock is not looking so good in terms of the skew in the options market, just looking at that one data point. Now let's talk about some things because, one of the areas that there was a lot of optimism about was the Treasury auctions last week. We had threes, 10s, and 30s in excess of 100 billion, and yet rates were flat to higher across the yield curve. The shorter end of the yield curve, rates are really moving up there, but on the longer end, they were flat to higher last week, which is not a great sign. And it suggests to me that positive correlation we've seen in rates and in the equity markets and particular areas of the equity markets could offer us some clues. If rates continue to move higher, I think we've got a chance for equities to move lower. Here's the S&P versus LQD, corporate debt. Corporate debt suggests the S&P is a little too excited here. Often is the case that corporate debt was leading the market higher. Not so much here. Now it's sort of flattened out and rolling over, yet the market is marching to all-time highs. That's a little concerning if it continues. Now, obviously, rates could catch down. That is to say that LQD could go up and catch up to the S&P, but we have to see that happen. And there's a number of other signs that are suggesting that if rates continue to move higher, there's other vulnerable pockets in the market. Another is retail. Retail versus the 7 to 10 year note ETF, IEF, suggests that XRT has some catching down to do if rates continue to move higher. Similarly, we see that with MBB, that is the mortgage-backed security ETF in green and home builders in blue. MBB suggests home builders could be rolling over soon, and this is important to watch. Another rate story. XBI, the biotech ETF versus IEF, a similar story of divergence. If rates continue to move higher, biotech may indeed roll over. And XLI, industrials versus IEF, the same story. If rates continue to move higher, industrials may roll over. And IWM, horse's favorite, the Russell 2000, surging as rates move higher, or the ETF for IEF moves lower. Another divergence that suggests if rates continue to move higher, small caps may be troubled. So I want to conclude it on this note that I know a lot of folks are all about the US stock market, maybe like 50 stocks are mostly what are traded, that's fine. And if you make money doing that and you enjoy it, great. But if you're looking for other places in the market to trade, there's plenty. And commodities and futures in general are a wonderful place for a lot of different reasons. One of which is that if you're trading commodity ETFs, you get these K1 schedules. They're a nightmare for you and your accountant. They often come late in tax season. Sometimes they come after you filed and you have to do a revision. Get rid of all that nonsense by trading commodities futures. Not a recommendation, just an idea to think about. Because you don't have those K1 schedules and you have more favorable tax treatment in terms of no wash sales and 60-40 in terms of how you book your short and long-term capital gains. So why do I mention that? Because look at some of the winners year to date. Certainly outperforming the US stock market are things like cocoa, orange juice, heating oil, sugar, cotton. And of course, you can go overseas and look at the Nikkei 225 in Japan, outperforming US stocks. And there's hedged options like HEWJ. Feeder cattle, gasoline, live cattle, lean hogs, rough rice, crude oil, all outperforming the NASDAQ and S&P year to date so far. So there are always opportunities out there outside of U.S. stocks in other regions and other asset classes. Something to think about, something we talk about often. So I thank you all for tuning in. I hope you enjoyed this episode of Navigating the Markets. If you have any questions, leave them in the comments or ask me on Discord. And until next time, this is Mayhem signing off.